What if I told you that your dividend investing strategy might actually be working against you? And that there's one critical mindset shift that separates the successful 10% from everyone else. Today, I'm revealing not just why most Singaporean investors fail to live off dividends, but exactly how the successful ones do it, including the psychological traps that hold people back and the powerful invisible process that creates real wealth. Stick around until the end, because I'll give you a complete 5-point blueprint for picking winning dividend stocks right here in Singapore. This is crucial information that every Singaporean investor needs to see. So please, do this for your future self. Like this video right now so the algorithm shows it to more Singaporeans. Subscribe to Wealth For You channel and hit that notification bell so you don't miss our life-changing wealth-building tips. Hey there, savvy investors. Welcome back to Wealth For You, the channel where we make growing your wealth in Singapore simple and achievable. Today, we're tackling a dream so many of us share, the dream of living off dividends. Imagine that. Your money works hard in the market, so you don't have to. It's the ultimate financial freedom. But here's a shocking truth. While almost everyone loves the idea, very few people actually reach that finish line. In fact, in developed countries, fewer than 10% of retirees live entirely off investment income. So why is that? And more importantly, how can you become one of the successful few? Well, it comes down to understanding both the psychology and the practical strategy. Let's dive in. Before we continue, just a quick note. This video is created purely for educational and informational purposes. It's not a buy or sell recommendation, and definitely not financial advice. Always do your own due diligence or consult a licensed financial advisor before investing. Chapter 1. The Reality Check. Why so few make it? First, let's talk about the simple but tough math. The average dividend yield from solid companies is usually between 3 to 5%. So let's say you want $40,000 a year. At a 4% yield, you need $1 million invested. If it's a 3% yield, you need a whopping $1.33 million. But if you can find a 5% yield, you would need $800,000. That's honestly a lot of capital. And the reality is, most people never accumulate that much. Life just gets in the way. Money sits in savings accounts or we increase our spending instead of our investing. But here's the good news, and really, the crucial bridge to understanding the solution. It's not impossible. The people who achieve this aren't all born rich. They simply follow a different playbook, one that's more about behavior than brilliance. Chapter 2. It's a get-rich-slow method. The success formula. It's a get-rich-slow method. The winners share these key habits. Early planning with long-term thinking. They think in decades, not months. Consistent investing over 20 to 30 years without stopping. Living below their means with aggressive saving. Reinvesting dividends to harness the power of compounding. And focusing on building cash-flowing assets rather than just chasing a higher salary. But here's where, honestly, most people get stuck psychologically. Knowing what to do is one thing. Having the discipline to stick with it is another. Chapter 3. The Mental Traps That Hold Investors Back. Many people, fall into the free money trap. They see dividends as free money, forgetting it's actually a return on capital you already invested. Without significant capital, honestly, the income just stays small. Then there's the consistency problem. Most people don't really stay the course. They chase quick wins, dip in and out of the market, or increase spending instead of investing. But the biggest mindset shift? It's understanding that true dividend wealth isn't measured in possessions like cars or houses. It's measured in cash flow. This is why people get discouraged by small $50 or $100 dividend checks. They just don't see the long-term potential through reinvestment. Chapter 4. Your Complete Blueprint. How to Pick Winning Dividend Stocks. Okay, so how do we actually build this? It's not about chasing the highest yield today. It's about finding stocks that will pay you reliably for decades. Here's your 5-point checklist. 1. Growing revenue and profit is king. You want a company that's growing. Look for a track record of revenue and net profit growing between 5 to 10% per year on average. This shows the company is healthy and has more profit to share with you. A perfect Singapore example is DBS Bank. Over the past decade, DBS has consistently grown both its revenue and net profit. For instance, from 2019 to 2023, their net profit grew from $6.39 billion to $10.3 billion. That's impressive, steady growth. This strong profit growth is exactly why they've been able to increase their dividend from $1.20 per share to $1.92 per share over the same period. Also, check that their revenue isn't all from just one or two customers. We want a diversified business. This is crucial for stability because if one client leaves, it doesn't sink the whole ship. Think about DBS again. They serve millions of retail customers, thousands of small businesses, and large corporations across multiple countries. No single customer can make or break their business, which makes their dividend payments much more reliable. 2. Cash is queen. Dividends are paid in cash. This is so important. A company can be profitable on paper but have no cash to pay you. You must look for strong and consistent free cash flow. Think of it like your own wallet. Your salary might be high, but if all your money is tied up in bills and mortgage payments, you can't go on holiday. Similarly, a company needs free cash after its expenses to pay dividends. A great Singapore example is Singtel. Let's look at their latest financial year. They reported a net profit, but more importantly, they generated over $2.7 billion in free cash flow. This massive cash generation is exactly why they've been able to maintain their dividend payments consistently. Even through challenging economic times, they literally have the cash in the bank to pay shareholders. Whereas you want to avoid companies with negative free cash flow. They might show accounting profits, but they literally have no money to give you. 3. Bet on boring and essential businesses. For steady dividends, sometimes boring is beautiful. Look for mature companies that sell things people need every single day. A perfect example right here in Singapore is Sheng Siong. Think about it. No matter what's happening in the economy, people still need to eat. We're talking about your grocery staples, household detergents, and everyday essentials. These are products that form strong customer habits. You're probably visiting their stores every week without even thinking about it. This incredible business model means Sheng Siong can maintain stable revenue through good times and bad. Plus, as we've seen with rising costs, they can adjust prices when needed, without having to spend millions on new research or product development. The result? Consistent profits that have allowed them to pay and even grow their dividends year after year. That's the power of betting on boring. 4. The Dividend Payout Ratio. Your sustainability meter. This is your secret weapon to avoid the dividend trap. Don't just look at the yield. Look at the dividend payout ratio. I look for a sweet spot between 20% and 60%. This means for every $100 of profit, they pay out $20 to $60. Think of it this way. This conservative approach leaves a healthy buffer for bad times. If profits dip slightly, the dividend isn't immediately threatened. More excitingly, it also creates room to increase dividends later without straining the company's finances. If the ratio is consistently over 100%, it's a huge red flag. They're essentially paying you from their savings, or even borrowing money, which is simply not sustainable long-term. The dividend might look attractive now, but it could be the first thing cut when trouble arrives. 5. Think growth and value, not just yield. Sometimes a lower-yielding stock can be a far better buy. The key is to look beyond the number today and focus on companies with strong potential to grow their dividends over time. A great Singapore example is a REIT like Parkway Life. They own hospitals and have leases that can increase rents based on inflation or the hospital's revenue. This is a powerful mechanism. As their rental income grows year after year, so does their ability to grow your dividend. Even if the starting yield seems modest, this growth can turn it into a powerful and rapidly increasing income stream that soon outpaces a static, high yield. And here's a crucial tip about price. Don't be scared off by a high share price. A $200 stock can be cheap if its dividend yield is high relative to its own history. The real trick is to compare the current dividend yield to the stock's historical dividend yield. You want to buy when it's trading at the high end of its historical yield range. Chapter 5. Important reality checks every investor needs. Now, here are some crucial nuances that successful investors understand. First, diversification is key. Those who live off passive income rarely rely only on dividends. They often combine it with rental income or side businesses for extra stability. Why? Because dividends aren't guaranteed. Companies can cut payouts during tough times. Relying 100% on them carries risk. Also, understand this is an invisible process. The results of compounding look small for years before suddenly becoming significant. This is why most people give up too early. But the beautiful part? It's about options. Dividends aren't just for retirement. They can create financial flexibility much earlier in life. Final thoughts. So, let's bring it all together. The system works. Dividends have built wealth for over a century. The problem isn't the system. It's that most people never commit enough time and capital. The goal requires consistent, long-term investing built on patience and discipline. The strategy: use our 5-point checklist for picking stocks. The deeper lesson here is powerful. True financial independence is rare because most people never develop the right mindset and habits. But if you embrace this get-rich-slow approach, focus on cash flow rather than possessions, and stay consistent through the invisible years, you have the power to step out of the cycle and build your own financial independence right here from Singapore. If this was helpful, smash that like button so more Singaporeans can watch it, and subscribe to Wealth for You for more simple wealth-building tips. What's your biggest challenge with dividend investing? Let me know in the comments below. Thanks for watching, and remember, your financial freedom is worth the patience. See you in the next video.